Welcome to Beyond the Risk, the podcast where Westfield specialty leaders break down current specialty insurance markets trends, challenges, and solutions, and what they mean for your business decisions every day.
Hello, I'm April Brackett, Vice President and Head of Marketing for Westfield Specialty. Welcome to our new podcast, Beyond the Risk. During this podcast, we will dig into complex, emerging, and non-standard risk. We will talk about specialty insurance and how it is being used to help businesses face real exposures. Today, we will be discussing financial lines. Regulatory scrutiny is intensifying, fintech innovation is introducing new exposures, and boards are facing heightened accountability for governance and risk oversight. Management liability and financial institutions coverage has always been critical. But what has changed is the pace and complexity of risk. So today, we are going to talk about what's driving these changes, how insurance carriers are responding, and what brokers and insureds should be thinking as they navigate this shifting landscape. And with that, let me introduce our guests, Ray Ash, Executive Vice President, Financial Lines, and Jan Tourangeau, Vice President, Management Liability from Westfield Specialty. Okay, let's jump in. Financial lines exposures are evolving rapidly. From your perspective, Ray, what makes them uniquely challenging?
What's uniquely challenging about financial lines is we are underwriting to the individuals leading a company. So it's a board of directors and the executive team. And those human behaviors are the basis for how we're trying to determine risk. What are their motivations? What are their goals for their organization in the upcoming year? And oftentimes those decisions make headlines. And those headlines will drive investor behavior and stock price changes. So you think about someone like Elon Musk, right? He has created amazing companies. He's tried to combine them. He's tried to sell some. He's tried to buy others. And he's trying to create value ultimately. But there are times when he's tried to convince his board of directors that he deserves an outsized pay package for that. And most recently to the tune of $1 trillion. And while all that's well and good, the board approved that pay package, but shareholders sued to prevent that from happening because they thought that was an egregious thing. Now that creates liability and exposure, and a D&O policy would possibly respond to that.
Got it. Jan, anything to add?
Yeah, I mean, aside from that human element, which is so very important when we do look at risks, there are a set of external factors that we look at when we are analyzing a public company. First being financial health of a company. We really want to make sure that they are stable, that they have a good cash runway. There is no distress that we need to be worried about. Stock volatility is another really important one, and one that you find claims stem from a major stock drop. So always looking at the performance over the past 12 to 18 months is really helpful for us. And I'd say lastly, the quality of the board and their governance. And I think we'll get into that more today, but that's becoming such an important factor when we look at these risks. And it's really at the forefront of what underwriters are looking for in going into 2026.
Yeah, some of the trouble is that we only get to talk with our clients once a year, right? And you try to take a snapshot in time, kind of like an annual physical, right? You kind of get your health check, you get your data metrics to see if they kind of meet your doctor standards. While we're not doctors, we still try and think about, well, what is the organization going to look like in 12 months? But really, we're trying to figure out 3 to 5 years from now because we are not transactional in nature. So we're really looking on a longer horizon.
Yeah, that makes sense. It's really fascinating. I had no idea that management liability and financial lines was, in a way, you're underwriting people and human behavior and the decisions they make. And you're also looking at the market volatility and the regulations. That's a lot. So speaking of regulations, how is regulatory pressure influencing the way insurance carriers underwrite management liability and financial institutions coverage?
So I do think regulatory pressure will be at the forefront in 2026. You have the DOJ and the SEC that are really expanding their focus into more regulated disclosures, especially with the AI space, cybersecurity, even ESG. So I think there's so many different factors to consider with just regulatory alone that I do think we'll see a momentum shift in 2026.
Yeah, and I think the current administration signaled that they're willing to take a lighter touch when it comes to oversight of public companies, right? And that extends to financial institutions as well. But the one example is SEC enforcement is already down 27% year over year, and only 4 public companies were targeted in enforcement actions in 2025. So what does that mean? So we believe that it creates an environment where private right of action increases. Securities class actions, lawsuits brought by shareholders are going to increase, right? We haven't seen that yet because the administration's been in place for about a year, and we'll talk about it later, but the SEAs are down slightly from 2024. That being said, the economy is doing well. Employment is steady. We'll see where that goes. So one other facet that the SEC has introduced is that in the absence of their target enforcement actions, they're going back to bread and butter enforcement, which means insider trading allegations and chasing down those kinds of leads. And so I think it's more about individuals rather than the corporations and the entities. Interestingly enough, so the DOJ also similarly a lighter regulatory touch when it comes to antitrust enforcement and objections to potential mergers and tie-ups amongst companies. They've introduced a program uniquely with the Postal Service that is allowing for whistleblowers to come forward and inform the government of any breaches of antitrust violations, and they can actually be subject to a 30% benefit from whatever award that the DOJ ultimately.
What does all this mean for coverage? Let's talk about coverage. Do you expect regulatory or litigation trends to materially change how financial lines coverage is structured or priced?
So while the market has seen a period of stability, we also have been seeing downward pressure on rates. And I do think that the emerging risks in both AI and the regulatory front will have an effect on pricing long term. Again, we've seen it kind of be stable where not a ton of rates coming into some of these programs. But I think this new market will give underwriters a chance to really push back and be a little bit more disciplined with their risk selections with regards to D&O coverage.
And much of our market is driven by supply and demand, right? So there were a few new companies, including ourselves, who came into this market in the last 5 years, let's call it. Now, some of them were short-term focused, and we'll talk about that in a minute, but I think that there haven't been any really new carriers enter our space, and actually there have been a few that have exited. So I think that balance is coming back into cohesion, and I think that to Jan's point about terms and conditions changing with the evolving risks of companies, and then no new carriers willing to take on disproportionate risk, it's going to help kind of moderate our environment.
And continuing on the topic, what do you anticipate for litigation trends?
So what we're seeing is securities class actions are actually down in 2025 compared to 2024. That being said, the size and severity has increased. And we're seeing that because when an SCA is filed, there's typically, or more often than not, you see a derivative demand run parallel with these securities class action. And that alone is making these losses more complex and more costly. And then you throw in the rising cost of defense. It really is, it's something to be said. And I think we're starting to see these losses hit higher up the tower. So I do think that should give the ability of the carriers to kind of come back and rethink about how they're pricing the risks and where they're attaching. What do you think, Ray?
Yeah, I think we've seen a classic bull market for the last almost 15 years now. And companies that have been more successful, their valuations have risen dramatically. And in our world, the larger the market cap a company has, any sort of stumble on a percentage basis will create a large set of damages for the shareholders to sue off of. So I think that we have a ton of very successful tech companies. AI has been massively influential, not just tech, but even the remainder of the world, other industries, and investor expectations have ballooned as a result. So you couple that with the idea that this year in 2026 so far has been the year of IPOs. And those IPOs through incubation with private equity and other private capital have created very large valuations for themselves when they're coming out at the IPO phase. And so any sort of stumble early days with an IPO can be very troublesome. Again, on a percentage basis, those alleged damages will be large. And to Jan's point, the programs are being impacted higher up the tower and the pricing hasn't kept pace. So I think that supply and demand concept we talked about before, where the new carriers were more apt to kind of fill those middle layers are harder to fill because the pricing wasn't adequate, those are going away.
Let's move on and discuss claims a little bit, given what you just outlined with the size and the severity of the claims. Jan, tell me what you're seeing for claims in the ML and FI space.
Sure. So the claims that we're seeing that exhaust towers probably the most are securities class actions that are tied to a derivative for a large market cap company. So think the larger they are, the further they fall. That's kind of how I look at it when I'm looking at claims.
Yeah, so I think following on Jan's comment, we're looking at also inflation of defense cost spend, right? So there's a concept in insurance called social inflation, and for some people, those are nuclear verdicts, and those are more casualty related per se. But in financial lines, we rely on very sophisticated white shoe law firms and other counsel to help us, help our clients defend themselves from these allegations. Now, what's happened is not just general inflation, but partner rates have gone through the roof. And what used to be kind of a baseline of $1,000 an hour today is over $3,000 an hour. And what's interesting too, another facet of the way our industry has worked, because the defense spend has been so voluminous, it's definitely going to burn through retention. And the primary carrier oftentimes simply throws their hands up because their limit is already going to be completely exhausted by defense spend. So what happens is that the excess carriers are becoming much more involved in claims management, in bill review earlier than historically expected. So I think that's also affecting that kind of pricing dynamic that Jan talked about and the potential for change in our industry.
How should brokers think about structuring layered programs for clients with complex financial exposures?
If you want to place business with a carrier that is stable and going to be in this class of business and industry for the long haul, especially through various market cycles, I think too often we see carriers come in and undercut price to try to win business, but the minute a claim comes in is the minute they are out of the business. So that sustainability is going to be really important when you are looking to place these more challenging risks. And then I would say the second part of that is making sure that the carrier has a solid claims history, claims maturity, dealing with a claims team that has been down this road before and had success in navigating these complex claims is really going to make a difference as to how the outcome is. I don't know if you have anything to add.
Yeah, I would say maybe it's telling that I was a broker at one time and I'm no longer a broker. But it's everything that Jan said is spot on. I would only add concepts of program structure. And traditional structures include what they call ABC coverage, which includes a facet of non-indemnifiable and indemnifiable coverage. Indemnifiable means there's balance sheet assets to pay for the defense costs and any sort of settlements. But the side A is in the absence of that, right? So that's either a bankruptcy scenario or a public policy preventing forwarding indemnification for some behavior that's so egregious. Clients have also bought standalone side A on top of their ABC. So the traditional program probably is 2/3 ABC, 1/3 side A. I know earlier on the podcast, we talked about some companies whose valuations are so large, they're almost uninsurable. And what that means is the potential damages from even a 10% drop in their stock price would completely erode entire $100 million tower. So what they have to do is buy side A only. And that's kind of the sleep insurance for the board and the executives, just in case something really unfortunately goes wrong unexpectedly. And then that is how they'll respond. They'll have coverage to respond. So what's evolved is these huge tech companies who only buy side A now, right? Because their market caps are so large and their exposures are so large. So that's one thing that's really important for our brokers to explain clearly and accurately with their clients to ensure they're utilizing their clients' capital in the best possible way. The other thing to think about is kind of a blast from the past. When I started my career in this business almost 25 years ago, it was during the dot-com boom and bust. And at that time, it was very common for carriers to offer 3-year policies with something they call a stretched aggregate limit, meaning there's only one limit to pay over those 3 years. And at the time, the volume of securities class actions weren't at the same level they are today. So while it wasn't great, it caught up with them. And what's happening now, and we're starting to see some brokers and some clients choose 3-year programs for their IPOs. IPO companies are more sensitive to litigation because 33 Act exposure is strict liability. It's a lower hurdle for shareholders to bring a lawsuit and be successful in those lawsuits compared to mature companies who have gone past the 2-year 33 Act exposure window. So when you look at a 3-year program for those types of companies, you're really risking a chance of a claim coming in and then being bare after that. So it's something that is coming back into fashion, which doesn't make a lot of sense. To me personally, we're not supporting those programs, but some clients need those programs, and that's fine. Just make sure as long as the brokers are explaining their risks correctly.
So to summarize, brokers should prioritize insurance carriers who are committed to the space, who also have dedicated underwriting professionals and claims professionals to really take a look at customizing that coverage for their unique needs.
The claims professional piece is really important. From the start, Westfield Specialty hired in-house claims counsel. That differs compared to other startups who are our competitors who relied on outside counsel.
Now, moving on to coverage gaps, evolving needs, and emerging exposures. Ray, where do you most often see gaps between those sort of traditional legacy financial lines coverages and the evolving needs?
So I would say that over time, with the amount of competition that's existed in the financial line space, you ultimately reach a point where you can't compete on price anymore. So what happens after that is terms and conditions. And so there's been the broadening of terms and conditions, I would say over the last 10 to 15 years, to the point where I think we've reached a saturation point where it's gone far enough. Now, there are different nuances, whether it's a public company or private company or a financial institution. There's a product called general partnership liability for alternative asset managers. I think private equity firms and VC firms, where that coverage, because they use sophisticated outside counsel to help negotiate the coverage with their brokers, it's gotten very, very broad. And what we've seen is that there are a number of carriers who are refusing to entertain that coverage now because they've incurred so many losses over the years. So again, supply and demand, with those carriers either unwilling to support certain clauses or terms, that's one thing, or are they exiting completely, which then creates less competition and increases prices. Yeah, Jen's point earlier about clients who choose companies with short-term solutions, that's fine. They sometimes need that, right? Because they're the most price competitive and they're satisfied with their rating, whether it's A- or something else. That's okay, right?
And Jan, you mentioned AI earlier, and we discussed kind of the AI governance. What trends are you seeing in underwriting, like tighter terms, higher retentions, more focus on governance practices?
Yeah, so I still think the market's pretty competitive, though we are approaching a point where severity trends may start to take over. I think carriers, underwriters are starting to see that these losses are more significant and the severity is there. And it's chewing up programs a lot quicker than we've ever seen before. My hope here is that this gives us an opportunity, as on the carrier side, to really push back and make sure we're putting the right risks on the book. We're being disciplined about what classes of business we want to put on the books. And again, I think regulatory is a whole nother facet that we have to be aware of when we are looking at these risks.
Yeah, I don't have much more to add. I mean, I know we talked about the private equity space before and the supply and demand of terms, conditions, and pricing and carriers entering and exiting. But there's a larger macro concept of, and I don't know if you know this, but there are more private equity firms in our country than there are McDonald's locations. So you think about from the macro perspective, there has to be consolidation, right? There can't be so much private capital flowing to these portfolio company opportunities because the exits aren't valued at the same way that they bought them on the way in. Whether the government gets involved, whether organic M&A amongst firms occurs, we'll see. But as Jan said, for us, with our long-term vision and our long-term commitment to this industry, we're just trying to be patient and be choosing the right risks for the long term.
And Ray, you mentioned the private equity space. Are there specific industries or sectors where financial lines coverage has become almost essential due to the heightened risk?
It's fascinating. So you think about in the absence of insurance, right? I don't want to make this pitch that insurance makes the world go round, but in this space, it does. So 99% of public companies buy D&O insurance. Because if you think about it, if for some reason they don't, and they rely on the company's balance sheet to indemnify them and pay for their defense costs or settlements in the unfortunate experience of a government investigation or a securities class action, what happens if the company somehow, some way goes sideways and doesn't have indemnification, right? And so then what does that mean? Those individuals are personally liable for their own defense costs and settlements. So it's really an easy way for these individuals and the entity, the corporation, to transfer a very, very small portion of their balance sheet to buy insurance to offset that exposure. I think it's something that's evolved over time.
And I think, too, when we look at classes of business in particular that may have a heightened risk of litigation, technology companies come to mind, right? I mean, especially those that are involved in AI or fintech. The adoption of AI is outpacing the regulation around it. So it puts a lot of pressure on the boards of these companies to really stay in tune with what's needed. And then the other one I think I would point out is biotech and life science. They come with a heightened risk because they have long developmental timelines. They're dealing with different regulatory bodies and reimbursement dynamics. There's just a lot of facets that go into life science and biotech. So in particular, those come to mind as some of the more heightened risks in this space right now.
I'd like to switch gears a little now and ask about emerging exposures. You've talked a little bit about AI, fintech, digital assets. What emerging risks are creating the biggest challenges for boards and executives?
You mentioned it. AI is a hot button topic. The question isn't even about are companies using it? It's about how are they using it? There's so much regulation around AI right now. And I think I mentioned it when we were talking about tech companies. The adoption is outpacing the regulation there. So there is a lot of pressure on these boards. The other thing I think that's important is geopolitical instability, right? This is another trend that we're watching pretty closely. We have tariff issues, trade sanctions. There's just a lot of instability. So it is on the forefront of the underwriter's mind when we are looking at risks like this. So AI is, to me, the big one.
Yeah, so those are all great points, Jan. I mean, I think we said it before, right? And one of the challenges in our business is we can only talk to our clients every year, like once every 12 months. And so many changes happen in that meantime. So again, we talk about human behavior and how we have to underwrite to the motivations and ideals of what they're trying to achieve for their companies. What sometimes happens is they take a dramatic turn in the course of a year, and they'll get into a retail company will get into crypto because they think there's upside in the value of cryptocurrencies. So what happens is they'll either use corporate capital, their assets, cash on the balance sheet, or they'll take on debt to bring those crypto assets onto their balance sheet and hope for the best and hope that those values rise faster than they can build a business themselves. So it's an alternative strategy that we weren't expecting in an underwriting phenomenon and during our underwriting process. And what happens is there are two things. One is crypto is very volatile, right? And the price goes up and down every day. But also accounting rules require companies to market the value of those assets. What does that mean? That means if the value goes down, you have to hold the value at the lower price on your balance sheet and you can never reinflate it. And so sometimes it really destroys a balance sheet faster than executive was expecting. And so that's kind of a danger, right? And so, so those are some of the things that an example of what happens in our world. Fintech, as you said before, that's a really exciting space because it's helping some of the unbanked to have access to the banking economy and bringing credit to people earlier and easier and sooner, but oftentimes it's untested. And so we're really trying to be thoughtful about the companies we support and make sure, similar to how our company expects us to be diligent in our underwriting, that they're as diligent in their underwriting for their clients and customers as well.
Yeah, I mean, I'm hearing like staying current on kind of like current trends in the economy and tech adoption and just the geopolitical exposures. I mean, that's a lot, but staying on top of it must make you really effective underwriters, right? Really understanding the risks there for our brokers and clients. Ray and Jan, thank you for being our guests today. And to all of our listeners, thank you for joining. Be sure to find all of our episodes wherever you get your podcasts. I'm April Brackett. Thank you for listening.